Francisco, 2 of us here, 1 in New York, full-time, and then 16 venture partners that are really all over the world. So they're in Asia, they're in across we're heavy here, we're heavy in Southern California, we're heavy in New York, we're heavy in Boston, and we're heavy in London and Switzerland and Sweden. As far as a really active LP base. And then we have a bunch of LPs that are very active that don't want to be publicly seen involved with the fund. So there's a discrete group that are extremely active that we leverage, for kind of every process of, what we do. Geographically, if anything is not in the Valley or New York, it's got to be better than what we're looking at here. And sometimes that could be pricing makes it attractive, but we're tracking a whole bunch of deals in cities where we have deep VC networks, like London, Amsterdam, Stockholm, Berlin, and so basically Northern Europe. For the deals that are far from home, they really need to already have a major VC backing it. Like we wouldn't just follow the big name angels into those deals. Enterprise and consumer for internet software and hardware is basically sector-wise. I like to see. We already talked about stage. We found ourselves making some pretty early stage investments where we feel very confident of what's going on. But in general, we try to be a little wimpy and come in when it's not like that crowded, every angel in the world has access to it. So I kind of talked about this where the VC fund invests into later stage seed. The LPs, our investors, can co-invest, even very small amounts. The VC fund invests in A and B. LPs co-invest. The fund stops investing because it doesn't see a 10x, but it's seeing some of those dynamics of those structured deals. And we're saying, hey, if you've got, might be a good deal for you as a corporate because you're going to do something strategic, or might be good for you as an angel to put in $250K and know you're going to double your money by the time your kids get into college and you need the money. Plus, we can help you sell your shares on the secondary market. Our fund, in some cases, will buy out an individual from a sidecar. We can introduce you to people that will buy you out of the sidecar and swap in other LPs. So we try to build in some liquidity. I think the lack of liquidity has made angel investing and venture capital investing unsuitable for the individual investor, whereas these other things are more liquid. So in the new world of liquidity, we're trying to address some of that. This is the portfolio that we're open about. I guess I'm not going to go through that. Part of our discipline is to make sure there's at least one big name VC in there. And it's not a matter of we can't do our own DD. I think if anything, we're better set up for deep technical expert, subject matter expert DD, which we do. I also don't confuse myself with Sequoia or Venrock. Like we were talking about that sound wave bit transmission deal that Intel Capital was leading, and I could see why it was strategic for them, but it might not be strategic for us. And so we really qualified it to know that we're different than Intel and that it still makes sense for us. And ultimately, we did do that deal. But I think your statistical probability, your mathematical probability of getting into billion-dollar exits go up when you're investing with the elite, who each have their own funnel to look at a lot of the deals, and these are the ones that they found themselves into. Just buying a logo and investing into Palantir now doesn't impress me either, which is not what we're not doing. And last thing is, the next book I'm working on is Masters of Corporate Venture Capital. And I tend to think that every corporate that's got even $1 billion of revenue should consider creating a CVC, Corporate Venture Capital Group. And there will be times when if they shouldn't invest unless they can get a business unit to say, I'm going to do something to really add value. So just like the angels, just like the Series A, B, VCs, if you can't add value, don't invest. And they should be able to unlock value. And ultimately, my old CFO said sometimes these companies put a $1,000 bill in the photocopier and hit print. And if you've got, like the Huawei example of how many smartphones are you guys making a year now? Do you know as a percentage or any kind of number? So 6% of all smartphones being made by Huawei. That's probably a lot. And it's probably a lot around the world. It's probably a lot in China. If you can get if part of your mobile app is underpinned by enablement, of getting it downloaded and installed onto a phone, and you can get Huawei to put your app on a phone, that's worth a lot. So I think that CVCs should exist, but if they make their list of why they want to be into it, they may find that being partnered in LPs in a couple of VC funds helps them get into the game fast, and then maybe a year or two later deploy their direct investing CVC. So I find it interesting writing the book. I was going to release it in September, and then I could see that writing the book was getting me meetings with the head of corp dev and the head of CVC at a lot of the world's important companies. And I thought, don't rush that. So I'm letting myself kind of slowly have lunch with all these guys and get to know them. And if nothing else, when my portfolio companies want access to them, we're able to make those intros. And we're hoping that over time there'll be some new corporate that hasn't made its own CVC yet that might end up being an LP, and that increases our power base. And I also think that the percentage of global GDP that the United States is responsible for is probably poised to go down as emerging markets catch up. And so to be able to be a Silicon Valley company that can go global really, really fast, I think is important. I think that there's some companies that could succeed in China and not succeed here. So to be able to position yourself to add value in these different parts of the world, from Middle East, North Africa to Asia, is important. So that's part of why I'm doing that. So with that, do you want to do any questions as a group first, and then we kind of go into one-on-ones? Were there any topics that you guys were hoping to cover today, or more in depth than what we went for? Well, I think a lot of VCs, or even angels on their AngelList profile, specifically say all I do is biotech, right? And I don't want to see anything but biotech, and they're sourcing from their network, and the kind of trashy deal flow that comes in on them from LinkedIn and stuff, they can not pay attention to. I say on my LinkedIn profile, I'll probably accept the LinkedIn connection and use this like Twitter. I don't read any messages on LinkedIn. So, there's a ton of inflow of messages on LinkedIn, and I just don't read them. And I would if I had time, but I don't. So I don't look at the super trashy deal flow that way. I might be missing a diamond here and there, but I'd rather spend more time to do quality work on a few deals that came through somebody that I know and trust, like one of our 16 venture partners, or an LP, or you, than stuff that comes in, over the ether like that. We try to say we only do this. We talk about our stage, sector, and geography, and I still get like stuff from Kazakhstan. So it would be nice to declare some sectors, because it might reduce the number of hours we need to work every day to respond and be polite to everything that comes in. We try to respond to everything. That at least it's on email, not LinkedIn. I would say that themes emerge over time. So we invested in Unicorn, which enables in-game gambling on video games and esports, and that's legal in places like UK and EU and Australia. And then you can gamble in the game for fantasy coins, unicoins, and then use that to win prizes everywhere else. And we witnessed how amazingly well that company is going, and that, holy cow, this looks like a Betfair. This will be a multi-billion-dollar deal. And then when this other deal came along, that enables people to bet during a sporting match. So you're watching like an American football or European football. Will he make the field goal, or will this guy have a base hit, or da-da-da-da? And then they can gamble skill-based with real money, and that's legal everywhere. When that thing came along, our experience with Unicorn made us move very fast on forget the messages in LinkedIn and look at that thing. And so, some investment themes kind of emerge along the way. Our success with NAVD led to a lot of other deal flows. So investment themes find their way. it's more about we have a disciplined checklist of like guidelines that we stick to. That is kind of a private internal document of, does it check the box of this? Does it check the box of that? Does it check the box of this? And it's a little bit, is it not that? Like we don't want, is there total risk of binary failure and understand it? Is there a direct line of sight to an uptick evaluation? Would this enable a secondary in 3 years? A whole list of things. So, but with the relationships that we have with so many tier 1 VCs, we don't want to alienate ourselves from any internet, software, hardware deals in the consumer enterprise space. But we stay away from things like a classic semiconductors deal. We stay away from capital intensive, clean tech. We stay away from a typical protocol deal that doesn't have any revenue in the near horizon, whereas that other one I talked about had revenue. We stay away from most things healthcare related because it's so highly regulated. Yet we like fintech, which is highly regulated because we now think we're quite smart on fintech based on investments we've made and LPs that we've got. And there's LPs that want fintech. We're going to get more areas of focus as LP base for Fund 2 comes together, where they're directly saying, these are some of the topics we really want, some areas of focus on. So we'll probably get a little more focused. But at the moment, I wouldn't want a fund that raises money from the European Bank of Reconstruction and Development and the province of, Eindhoven. It can only invest in Dutch deals in the area of Eindhoven. That would suck. And the deal flow that you're restricted to over there would disappoint me. Not to say anything bad about the guys that are doing exactly that, in Phillips and Tilburg University, but I prefer to be free to invest anywhere in anything I want, and keep it more to a list of guidelines that we promised our LPs, and we'll try not to deviate too far from that. And if we do, the LPs should be happy because we know something that can make us money. I think if you look at the changes of the internet from today to where we were 10 years ago, if you look at the changes to the evolution of the social networks, the evolution of platform companies, the ability to partner with companies, the ability to partner with corporates in a way that wasn't possible 10 years ago, why wouldn't you be focused on the internet and software, fast-moving digital sectors? And there is a bit of a renaissance of hardware that you can, things like Navdi and Iotera can move really fast and Percolata.
Advice would you give to a startup founder? The whole corporate venturing seems to really kind of heating up. What are the things, the top 5 things that you would advise them around taking corporate visibility early on?
Yeah. Okay. Well, corporates in the past were more Series C investors. Back when an A was a later stage seed, so they're kind of Series B investors now. And now the corporates have, at the board level woken up to, let's find out about these things before they're late on the adoption curve, for many reasons. I think there's a statistic that says like 29% of all VC deals include at least one corporate right now. That happened first big on the healthcare side. I used to be involved in healthcare through Founders Club, where they hit these patent cliffs and they had to truly outsource a big chunk of R&D through the VC sector. Advice would be take them seriously and be polite. I've seen a lot of CEOs say, oh, I don't want to talk to a corporate because they can't lead and they're going to be slow. They're not motivated because they don't get compensated and it's generally slow and they might not even be all that smart in the space. And one of the biggest mistakes I made personally in my career, probably the biggest mistake, was turning down a term sheet from Telefonica, AT&T, and British Telecom to invest in my company. And they would have given me a certain amount of minutes to flow through my network that would have made us $1 billion company on a discounted cash flow basis. And I was young and dumb and arrogant to think that this would alienate other telecom operators in the deregulated world, and I was a bit stubborn and not being versatile enough to shift. That the reason I founded the company was in response to deregulation. That it used to be bilaterals, that the minutes go from Deutsche Telekom to France Telecom, and France Telecom to Deutsche Telekom. At the end, they said, who sent more minutes? You're the net payer to the other one for terminating. And now there was like thousands of companies everywhere, all going through everywhere, and we made this website like the NASDAQ to handle minutes through our network and our banking, debiting and crediting. And I said, I got an email from level 3 saying, if I do this deal, would you continue to work with us? And he wrote back, we would end all business dealings with you the minute you deal with those monopolies. And I showed that to the board and got them to follow me to vote to turn that down. Dumb, 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 dumb. I should have just taken that. Don't worry about getting every carrier in the world to do business with me. Just do the guys that control 80% of all the minutes anyway. And the other club deals would have come in. We could have done a second round with the rest of the PTTs. You know, dumb, 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 dumb. And so that's a big mistake that I had to make myself to learn. And I've given this to my own CEOs, and they're like, yeah, but I really want to go out with all of them. You know, it's just really stupid. So it's a lesson that the young CEO still seems to have to learn and can't vicariously pick it up through my experience. So I'm a big fan of doing business with corporates if they can move fast enough. What can happen is, don't rely on the corporate. So here's some advice. Don't rely on the corporate to move fast enough to get in on your deal, because they may have some internal processes of like some head of a business unit has to sign off on it that we're gonna buy, not build, or we're gonna do business with it or something. And by the time your round closes, they don't move fast enough, so you close it, you're, let's say, 10 million pre-money, 10 million pre without them, and then a few months later, they trickle in when they're good and ready and make them pay up at a 20 million pre. Does that make sense? Yeah.
What about the whole area of the IP share, resources share? Is there some other issues that
Right, so I've heard people say the minute you take corporate money is the minute you've already sold your company, you just don't know it, type stuff. Well, the devil's in the details, and if you're going to license any, intellectual property to that corporate as part of the deal, have a delicensing program, have the delicensing agreement in the initial licensing agreement. So take a note out of the playbook of the biotech guys. Biotech has, from the beginning of time, financed their clinical trials with a mix of financial VCs, which if you peel them back a layer, they're like Japanese. They have all corporates as LPs, and family offices who have a family member with that disease that you've agreed to focus on. And then there's the partnering deal. So they do a $30 million round, phase 3. They get a bunch of, NEA healthcare group, and OrbiMed is in the deal. And there's a family office directly in the deal. And then there's a $5 million partnering deal that you agree to license for all of Japan and some other countries, a perpetual license for the software. But in the event the company is sold, this is what happens to that. So in biotech, it's extremely transparent what happens there. In tech, a lot of the entrepreneurs and VCs don't have that skill set. And so I would say copy what's happening on the biotech side for what you're doing in IT. And if you have sold your company from taking in some money, you should be aware of that. Some of those partnering deals have an option for the corporate to even buy the company at a certain price, but that's usually a price that everyone's smiling about at the time that they do the partnering deal. And I would say in today's market, if the company's really red hot, why would you cap the sale of the company to some corporate at 300 million when you're on track to do bigger than that? And so that just gets negotiated out, and the lawyers do what you agree.
The private IPO phenomenon that we've seen in the last year, we haven't really seen much of it before.
Yeah, so we talked about that a bit more. What do you want me to say specifically? Not just what's happened, but will it continue?
Yeah, and what the risks are to in particular the prior investors. Because it's late stage activity.
Right. Well, I think if you raise money, so if you and I are the existing ABC investors, and now we do a super high value valuation, that we wouldn't get that valuation in a single class of shares, IPO, but because we've given so many rights and privileges to the new investor, like higher than 1x liquidation
Each time
stack?
around- Each time around.
Right. Okay. And then now you're like Uber. You're doing it every couple of weeks. The risk is that you're elongating the time to liquidity for yourself, and because the valuation is so high, you want them to grow into that valuation rather than have a down round where you can get hurt. But you de-risk that for yourself by bringing yourself down to a zero-cost investment. So if you had put in $5 million into the company and I had put in $25 million into the company, we're now doing a $1.2 billion pre-IPO phenomenon, private IPO phenomenon deal. I would say, let me take $50 million off the table, not $100 million off the table, and you take a good 5-10x off the table, and leave our remaining 80% in there for the next uptick in valuation, as opposed to the guy who's like, oh, I feel it, I want to stay in here. It's like, well, we know that we don't know when a downturn comes. It can be weather related. So we know that we don't know. So when you're in that point, it may make sense, even if you're as diversified and liquid as Peter Thiel. He was doing it. He's a smart guy, and he was doing it with Facebook. And so I wouldn't let anybody strong arm me saying we have to stay in. You could potentially structure something with a crazy LP and say, well, if you like it so much, why don't you buy into this round? Does that make sense?
Yeah, yeah.
Were there other parts of your question we
Well,
didn't? I mean, I'm happy
basically
to go deeper on this topic.
Well, our take was more one of, you spoke to it, is take as much money off the table as you can. Because it's going to be it's going to be a much longer cycle. B, whether you're a huge gap between the private and the public valuations. Who's to say that Uber's going to beat them up?
Yeah, let's talk about Uber, yeah, sure.
Because they're the big kid on the
They're the
block.
poster child of this whole thing.
Yeah, yeah. Who's to say they're going to have that kind of a valuation before they go public?
Well, I think that the answer there is that they will not go public until investment bankers confidently say to them, we can get this away at a valuation that's minimum flat of your last financing. And theoretically, it should be up from last financing. And so that's what I mean when I say these companies have to grow into that valuation.
Well, that's
When they move from super preferred structured shareholders, investors, to one class of shareholders, which is what an IPO, as far as I know, must be. Right?
yeah.
And an economic downturn will make it even longer.
Big unknown is what is that gap between private valuations that have gone through half a dozen rounds and the public valuation.
I don't know if I'm just pulling this out of thin air, but I tend to think people seem to think it's 2 years. You tend to think that 2 years will happen real fast. Kids will grow up fast, and like within 2 years we're gonna be out of this thing. And in 2 years, I mean, like it wasn't that long ago. If you get on Google Maps, it just said walking, public transit, car, and now it says Uber, and it gives you like an estimate on the price and the time to get it. Like the usage of Uber's got to go up. I mean, it's not going to go down. And even with all the clones, they got a really committed CEO there. You tend to think people investing in Uber are probably going to double their money, and it'll take 2 years to grow into that valuation, and then they'll get it. It's a bit odd to put. It's a bit like maybe think about some people are afraid of venture debt, and like Bill Draper once said to me that he thinks venture debt is bad in every single case. Always, and I think at some point, based on your, tax burden, it makes sense to have some debt in your, that equity structure. You know what I mean? Like, how can you argue with that, or to minimize dilution for founders, management, and existing investors, as you want to continue to go for the big G in your discounted cash flow of growth? To say that this pre-IPO phenomenon is a bad thing because there are discrete, clear risks that we can see. It's probably as silly as saying venture debt is bad in every single case. So I think that you're just putting a little bit of kind of venture debt style risk on the company that enable all of us to get more money out at the crystallizing liquidity event. From my perspective, if we can get money off the table now and increase what we can get on an exit, then it seems like we made a decision to take some kind of venture debt into it. So it's that sort of risk. The scary part is what happens with the economic downturn. I think that each company will you'll see how profitable a company is when an economic downturn comes. You know, do these companies have the ability to cool their burn rate? You know, so I hear people like at Excel moaning about the burn rates that are out there. That if you give a CEO $1.5 billion that he didn't need, and then a week later give him $1.2 billion, they're going to be like, let's have a big party in Paris. That's a good idea. You know, and they'll start thinking of ways to spend the money that in a more disciplined, you know, point in history they wouldn't have done. You know, so I think that if you've got a company like my old company, we could not cool our burn rate. We had switches and bandwidth connecting them. I could fire 90 people, but I couldn't get out of contracts that I was committed to. You know, maybe I could have done a better job of just saying, come up with a baseball bat, I'm not going to pay you. But, you know, it was hard. So I think that if you're in that risky zone, but you know that you could just cool down growth and then immediately flick the switch to a outrageously profitable company, then you're safer. And now you can go a year or two on top of that to grow into the valuation. Cool. All right, listen, thank you everybody for coming. I'll stick around for a few more minutes, and look, it's been great meeting every one of you. Thanks so much.